Hi there, it's Bill with Smart Trades, and it's Monday, May 9th, around 11:10 a.m. Pacific Time. And let's start off with a look at the 30-minute NASDAQ. As is often the case, these charts are a bit dated. Actually, these charts went out in a report earlier this morning, and some of them actually are dated from Friday when I put out a report for my clients. But at any rate, most of what's here still stands, and I'll update the charts verbally where it's necessary. At any rate, this is the NASDAQ 100 30-minute chart. This is from earlier this morning, and what I had noted at that time is that we possibly were having a series of 1-2s to the downside. I'm not totally clear on that. I'm waiting for confirmation that this rally is going to roll over. Breadth has actually improved a bit from this time, but we have rallied into this 2395, 2400 area, which is consistent with a potential small wave 2 or some kind of corrective rally. Additionally, you'll note here we did have bullish divergences on what I'm labeling this B wave low back on the 6th. This is still my working primary count, that we have peaked, that we've got an impulse down. I'm less than certain of this on a short-term basis. Nonetheless, one of the things that I look at is risk reward, and the most important thing I think here is that even if we are going to work our way a bit higher, I think the greater risk, at least in the short to intermediate term, is to the downside. More on that a bit later. But at any rate, here's the count on that NASDAQ. You can see a pretty clear 5 waves down, an irregular or expanded flat wave 2 up, and then an impulsive looking decline. And again, you don't have all the data here, but we've rallied back into this 2395, 2400 area, and that's where we are right now. Now here's an alternate count. This is the S&P 500 cash, 130-minute chart. I like this chart length because you get 3 bars a day, you get some intraday definition, but you also get a little wider view. Again, this is somewhat dated from earlier this morning, and this count I originally posted on Friday morning and sent out to my clients. Note please that you've got overlap between wave 1 and wave 4. However, it's possible that this is a diagonal triangle evolving. If so, that's a very, very bearish count, and indeed some more on that later in crude oil, which we had counted as a possible diagonal triangle back on the April 29th video. Apparently has played out as such. At any rate, back to the S&P, it's certainly possible that this is a diagonal triangle, and if it is, it would target about 1375, 1380. It doesn't have to get that high. It could exceed that level somewhat, but that's the ideal target. Anything over 1371 would provide a moderate new high compared to this wave 3 peak and complete a potential 5 waves up. And again, a diagonal triangle, very bearish pattern if indeed it's playing out. We have rallied up a bit here, but at this point it's not clear that this is in play or if we're just correcting this decline. One thing to look at is that this decline has kind of formed an expanding triangle. That's more obviously of a corrective type pattern. So if we hold this low, I believe it's around 1329, it's certainly possible that we're in a diagonal triangle, and again, a very bearish pattern. Back to the NASDAQ, and again, this is the primary count. This is the count I favor, and the reason that I favor it is not so much that the short-term wave count is so definitive, but because the risk is down to the March lows, assuming that this count is correct. Here again in the S&P is the diagonal triangle, a little bit more perspective. A move to 1405 negates the diagonal triangle. In that case, wave 5 would be the longest, and that's a no-no for diagonal triangles. And but in the meantime, 1375, 1380, the ideal targets, if indeed it's a diagonal triangle, and it needs to rally a bit more here to eliminate the possibility that this is actually an impulse down. So we're still working on that scenario again, that this is an impulse down, that we have in fact peaked, but we have an open mind, as always, to the potential. But again, in either case, the issue here is that the risk is at least down to the March lows. That's around that's under 1250 basis the S&P, and under about 2170 basis the NASDAQ cash. Now, here is another count. One of the things that's starting to bother me about our primary counts here are that this correction is simply lasting too long. Now, the assumption is that, or the assumption that I've had, is that we had a 1 up, 2 down, and that this decline that we're working on now, including the moderate new high, was a correction of similar magnitude to the decline here. Now, it's in terms of time, the correction is expanding out rather long in relative terms. It's much longer than our little wave 2. So, the other count is that folks are saying that this is a completed wave 4 here, what I have labeled as A. Well, the problem with that is there's no alternation between this small wave 2. And I apologize, I don't have it labeled here, but if you reference some of the older charts, I've labeled it multiple times. Now, if you kind of shift your perspective a bit, call this rally up to the 2010 peak 1, the decline into 2010, I believe that was the May flash crash, and the subsequent decline wave 2. Then we have alternation here. If we have a flat, we have similar magnitude in terms of time corrections, and we have 1, 2, 3. We're working on 4, and a fifth wave could actually take us, above the 1380 area. We'll cross this bridge as we come to it, but in the short term, it's not that big an issue, because whether or not this is a B wave of larger magnitude or not, the likely target is under the March lows in a C wave down. Now, if we overlap wave 1 here, then we'll have to reevaluate it. Perhaps one of the counts could be that this is a gigantic diagonal triangle, if indeed we get overlap. But that is going to be resolved months from now, so let's take it one step at a time. And for now, whether this is a B wave of this larger magnitude or the lesser magnitude, in either case, or if this is, again, the diagonal triangle count, it doesn't really matter. The idea in all of these counts is that we're going down at least under 1250 or so. So let's let it play out. Now, this is a chart I actually posted, I believe, on the video from April 29th. Again, this is crude oil. And I had mentioned at that point that we had a nice looking diagonal triangle. You had a declining momentum in terms of the ADX and volume, and a nice overlap, nice ABC structures within the wave 1 and wave 3 rallies. And indeed, here's an update that I did for my clients on May 4th, indicating the possibility that we had already peaked. We had a little diagonal triangle even within the fifth wave. And again, here are those momentum divergences and non-confirmations in volume. Now, this chart I actually posted and sent out on the 6th. And again, you all probably know that crude oil has had at least a mini crash here, and I think there's a pretty good probability that crude oil has peaked. Now, it didn't quite reach the 117 target in the upper channel on the weekly chart, which we've been posting for several months. However, we made a moderate new high above 3. The volume and momentum faded, and the bottom line is we broke that channel, and we have an impulse to the downside. So more than likely, I think that crude oil has peaked. What we want to look for here is confirmation of a corrective rally that fails below this high, which is right around 115. Natural gas also declined along with most of the other commodities, and although it's possible we still have a series of 1-2s, I think that's that's much less likely given the impulsive nature of this decline. I had mentioned in my analysis that it was quite possible that this rally was indeed an ABC instead of a series of 1-2s, and indeed it looks now like that's the case. Again, what you want to look for here is a corrective rally that fails below this 470 area, and that would be a small wave 2 rally up, or a B wave rally up, and indicate that there's another leg to the downside in natural gas. Gold declined on the heels of silver. However, gold has held its longer term support. This is a daily chart, and here's the weekly. As you can see on the weekly, not only are we holding support, but we actually are hanging in right near the upper channel. As Paul Simon said in one of his songs, one man's ceiling is another man's floor. Well, right now an area to watch is this 1430, 1435 area. That's the old resistance. That will come in as support perhaps if indeed gold has not peaked and may indeed have one more rally, even though silver, and here is silver, has probably peaked. A lot of folks say when markets get going crazy that the technicals stop working. I disagree with that. Oftentimes it's the longer term technicals that come into play. Folks aren't looking at them, they're looking at the 5-minute charts or hourlies or dailies or whatever. But if you look at the weekly chart of silver here, you can see that we've come down approximately to the long-term trend line if you connect these previous two lows, and also what can be counted as a small fourth wave type support. As is the case with crude oil and these other markets that we think have probably topped, what we want to look for here in terms of confirmation is a corrective rally that fails obviously below the 50 level, and preferably perhaps in that 40 to 45 area, a 50%, 62% retracement, something of that nature. But I think that silver has probably peaked. Gold, I'm not so sure about. Again, the idea here is that if we do get a corrective rally that fails below the peak up here at 1570 or so, then it's likely that gold has peaked along with silver and crude oil. And speaking of peaking, I think the euro has probably peaked. I think we have a rather clear impulse to the downside. It's possible that impulse has bottomed, but and we'll get a bit of a rally. Once again, what we are looking for here is a corrective rally that fails below the 149 area. Obviously, new highs negate the top by definition. One area that would be particularly important is this area 147 and change, this little shelf. We really don't want to see it get back into that area on a closing basis. That would be an indication that indeed perhaps the euro hasn't peaked. But one indication that it has also is the context of this decline. It's very difficult to count this as a C wave. And I think that's one of the best ways to determine whether or not you've got a change in trend, whether it's a one down or a C wave down in the case of a change in trend to the downside. It's not so much how low wave one goes or how high wave one goes if it's a bottom, but it's the context. And I think if you wait, for example, for a new low down here, you may miss the boat. So what I'm looking for is a corrective rally that fails below the 149 area, preferably below, say, 147.50. And that would be my cue to look for the short side. And finally, bonds. We've talked about bonds quite a bit in the past, and this is just a quick look at that chart. And bonds are starting to get into an area where they're potentially peaking in a C wave. You can see here we've got previous support and then previous resistance right around that 126 level. Additionally, we've got a channel that terminates, if we were to get up there in the next week or so, around 126. So this is an area to watch. And perhaps we'll see a decoupling of stocks and bonds. Who knows? On the other hand, this could be just A of a larger correction, ABC of A. Hard to say at this point, but again, I certainly would look at this 126 area as being a potential problem for bonds, and we'll see how it reacts when it's there. Anyway, thank you so much for watching. Have a great trading week and enjoyable week ahead. And thanks again. Bye-bye.